In our most important questions to ask a passive investor video, we mentioned that there was a lot to learn about loans. I'm Dan Cosgrove, the CMO of Anthem Capital, and today we're going to share the ins and outs for financing that large apartment complex purchase. And don't worry about taking notes. If you head over to our website, you can download our ebook, and that has all the information as well as several other educational readings that will help you learn about this wonderful world of real estate investing. So, without further ado, here are the key things to know in financing. First, the primary type of financing that we want to talk about right now is called agency debt. Agency loans are conventional fixed-rate first mortgage loans secured by stabilized income-producing multifamily housing assets like a Fannie Mae or Freddie Mae type loan. Fannie and Freddie are government-supported entities. The loan difference between the two is that Fannie buys the large mortgages from commercial banks, whereas Freddie buys mortgages from smaller banks. That's really the only difference between the two agencies. Now, these two agencies have competitive lending terms, but they also have some higher requirements for the everyday borrower. This borrower needs to have a prior track record of at least one multifamily property that's been in existence for over 2 years, has a FICO score of over 680, no criminal record as it pertains to any finance-oriented crimes, be within 100 miles of the property being purchased, or have an on-site property management team that will be on the property, of course, and have a property that has at least a 90% occupancy for the last 90 days. So that is what an agency loan is. But what if you don't qualify for agency debt? Well, then you can consider a thing called CMBS, short for Commercial Mortgage-Backed Securities. So a CMBS is also known as a conduit loan and is a great alternative to Fannie and Freddie. Unlike a bank loan, a borrower will not be working directly with your lender after that loan closes. Instead, you would be working with a master service company that administers that conduit loans. So the benefits of a CMBS loan is that it can offer attractive loan terms, go up to 75% LTV, cover a broader range of assets versus just a Class A type asset, has less red tape during kind of the underwriting process, and provides an ability to refinance during the holding period. And in a worst case scenario of filing for bankruptcy, it is a non-recourse loan. You might be wondering, what is a non-recourse loan? And I promise you I'll get back to it a bit later. Now, as for the disadvantages of a CMBS or a conduit loan, is that it might be more expensive to exit this loan if you want to sell your property earlier than you had originally planned, known as a prepayment penalty. And you might have to have more reserves required than usual in order to lock in this loan. So some of the requirements you're going to see in a CMBS type loan is that it has to be at least a $2 million loan, a max loan to value ratio of 75%, a minimum DSCR, debt service coverage ratio of 1.25, and be subject to that prepayment penalty if you plan to exit the deal before the term expires. So that's kind of the general requirements. Now, we've covered our two primary types of loans we receive in multifamily type of real estate investing, but there's one more type I would like to mention, and that is a bridge loan. A bridge loan does what its name suggests. Real estate investors get a commercial loan to bridge the gap between the time they get the loan and the time they can do everything they want with the property. Take, for instance, you get a value-add investment that only has an 80% occupancy and has a rehab plan that will ultimately increase your occupancy rates to at least 90% and then increase your rental rate. You could use a bridge loan to cover this value-add plan and then convert it to a more traditional loan after the property is stabilized. A bridge loan can close quicker as it is based on the value of the property, not the income being produced by that property. However, with the advantage of speed and flexibility comes a higher interest rate. There are certainly times to use a bridge loan, but it is more unique and not used for the long term, as a bridge loan tends to be a max of about 3 years. So we've covered now like the three financing options. Now let's hop into some of the terms that I mentioned above, starting with that non-recourse term I promised I would circle back on. A non-recourse loan means that lenders can collect the collateral of the subject property that the loan is against, but the lender cannot come after the borrower's other assets. A non-recourse loan tends to have higher interest rates, is limited to people with fantastic credit scores, and is restricted to only a few banks that are willing to assume that risk. On the other hand, a recourse loan tends to be a lower interest rate, but it allows the lenders to come after a borrower's other assets if the lender has not recouped all of their money from getting back the property if it fails. In this line of real estate investing, we tend to like non-recourse loans so that we can protect ourselves and our investors' best interests. Another term you might hear when it comes to financing is the term SOFR, or SOFR. That stands for Secured Overnight Financing Rate, and is an important interest rate that lenders use to determine their loan rates. SOFR replaced LIBOR, which is the London Interbank Offered Rate, as the primary reference point for dollar-denominated loans starting in 2020. The advantage of SOFR over LIBOR is that it's based on the observable data versus the estimated borrowing cost that LIBOR was about. So that's one thing that you're going to hear. Another thing you're going to see is when you receive financing, you have an option to take a fixed rate or a variable rate. It is more common for borrowers to choose a fixed rate so that they can avoid the uncertainty and have a consistent mortgage rate that they can budget for accordingly. A fixed rate tends to be higher than a variable rate because you are paying for that certainty. And with how the interest rates are climbing at the time of making this video in May of 2022, we are more than willing to protect our investors' returns by locking in a fixed rate. Another interest rate option you could receive is what we call an interest only, or an IO term. This type of loan is what the name suggests. Instead of paying principal and interest in your fixed rate loan, you are just paying the interest on that loan for a specified period of time. The interest only period is helpful in the first few years as you try to get your cash flow in order. But then once that interest only period expires, you have to pay the principal plus the interest at the to be determined interest rate determined by your lender. There are plenty of deals where you might see an IO period of 1 year so that it gives the borrowers time to get their business plan in place before they start paying the principal plus the interest starting in year 2 on that loan. A few more terms that I'll quickly breeze through because I know I've just given you a ton of information is LTV, term, and amortization. So LTV, that means the loan to value ratio. It means how much a lender is willing to lend in order to acquire the property. The typical LTV is between 65 to 80%, meaning that the lender will provide 65 to 80% of the purchase price and the borrower must provide the remainder. And the term is simply a reference to the length of time a borrower is locked into a loan. We tend to find 5 to 12-year terms. And then finally, the last part is amortization. Amortization is the length of time it should take to pay off the loan. Most loans have a 20 to 30-year amortization period, with the preference being given to the 30-year amortization to lower your monthly payments. So thanks for watching. My offer was accepted. What type of financing should I get to purchase this property? If you want to learn more about real estate investing, such as the top 10 reasons why to invest in real estate, the 3 keys to look for as a passive investor before investing, the 5 watchouts in real estate investing, and a lot more, you can follow us here, visit us at anthemcp.com, or scan this QR code, or by clicking the link below to get access to all the content we've created to help everyday investors just like you unlock your wealth potential.